On Monday, it will be 3.5 years since the stock market hit its recession low and a new bull market began. Tonight's Market Monitor is shifting to a more defensive portfolio. James Stack back with us, president of Investec Research, our longest running Market Monitor here on NBR. We want to congratulate you, Jim. Recently named one of the top 100 independent wealth advisors by Barron's. Always great to see you, sir.
It's great to talk to you again, Tom.
So pulling in your horns a little bit, let's think really short term for you. What do you expect between now and, say, the election?
Well, what's interesting about that 3.5-year birthday on Monday is that it's right at the median or average bull market duration or lifespan of all the bull markets going back 80 years. That doesn't mean the bull market's going to end on Tuesday, but it does suggest that it's becoming increasingly important to manage risk, particularly if you look out after the election.
Let's look before the election, though. Between now and then, there's the potential for volatility, but what does history tell us?
Yeah, investors expect it to be volatile in this 2-month period, and we're almost exactly 2 months out from election day. The historical odds are that it's not going to see a dynamic or big move in the market. In fact, there's been only 2 instances since 1940 in which the market has moved over 5% in this 2-month period. But here's what's interesting. These 2 months, from the stock market standpoint, carry a 90% probability of predicting who will hold on to the White House. What I mean by that is that if the stock market is up between now and election day, then the odds are 90% that President Obama will hold on to the White House, whereas historically, if the market is down between now and election day, the odds are overwhelmingly in favor of Romney and the Republicans taking it over.
Sounds like the campaigns need to be watching the S&P 500 as much as the job market these days. What about post-election? Because then we really run quickly into the fiscal cliff and all the volatility that could provide in 2013.
Yeah, if there's one thing certain about the fiscal cliff, it's that nothing's going to be done between now and election day. But politically and historically, the odds are high there will be some kind of a compromise that lessens the risk of that fiscal cliff. Nonetheless, I think the next 4 months are going to be critical for the market, probably the most critical of this bull market. Technical strength in breadth, leadership, bellwethers, those stocks that lead the market, is all solid. The technical strength is in place for this bull market to continue, but we are seeing cracks in the foundation in leading macroeconomic tools. Last week, consumer confidence fell sharply, with all of the decline coming in expectations. Now, if that levels off between now and year end, then fine. Then the market's going to stabilize and perhaps continue higher. If this is the start of a decline in consumer confidence and it continues falling later this month and in October, then it's going to be very difficult for the Federal Reserve or any administration to avoid a recession next year.
Well, you can hear you're still hopeful, still optimistic, still a little bit bullish here, and so you've brought in your horns a little bit. You brought some defensive picks along with you, amongst them the biggest global generic drug maker, Teva Pharmaceuticals, TEVE. It's trading about in the middle of its range over the past 12 months. What do you anticipate of Teva?
Yeah, Teva is, we've become more selective in our stock and sector selection. It's as a generic drug manufacturer and seller, it's going to be immune to the showdown over the healthcare reform. It's sporting a 7.1 PE ratio. That's the best valuation in 20 years, and its revenue is continuing to grow at double-digit rates.
Okay.
And I think the symbol on that is TEVA.
That's right, TEVA, thank you. Pepsi, PEP, an easy one to remember there. Also the Frito-Lay brand. It's been a nice, steady grower over the course of the past 12 months. You anticipate that pace to continue?
This is a solid value company. It's number 2 in food and beverage in the world next to Coke. And yes, revenues are going to slow from 13% annualized over the past 5 years down to just under 10% for 2013 and 14. But PepsiCo is selling at a 20% discount to its average historical valuation, and it's paying a 3% dividend yield, which is more than you can get on a 30-year T-bond right now.
How about it? Yeah, exactly. Paid by all those Dorito chips. ConocoPhillips is your energy play, and you mentioned some of the cracking in macroeconomic indicators, but yet you are moving into energy here. Why is that?
Well, I think investors have a lot of fears out there. And this is one of the best hedge against some of those fears, like a conflict with Iran that sends oil prices skyrocketing, or the very valid fears that the dollar could fall precipitously over the next couple of years. That's not out of the question. That would send oil prices higher. ConocoPhillips right now has become more of a pure oil exploration and production company after spinning off their refining and marketing. And right now its PE is at a single digit and it's paying 4.8% dividend yield. That's something you can really take to the bank.
All right, last time we saw you back on February 10th, you had 3 ETF picks, including the Energy Exchange Traded Fund. It's essentially flat, industrial's flat, but the technology's been a winner, up 11%. Do you still have these?
Yeah, technology has been very strong, and we're holding our technology stocks individually. We of course, hold all the stocks that I mentioned tonight.
Okay.
I think technology has had a strong run with the NASDAQ up 20%. I wouldn't be adding to that sector.
Right.
The energy I would still be adding to.
And you mentioned you do own everything mentioned. It's our Friday Market Monitor, James Stack with Investec Research.